The psychology of money, mastering your mindset for investing success. Money isn't just numbers on a screen. It's emotions, habits, and psychology. In fact, many experts say that 90% of investing success comes from mindset, not math. The stock market doesn't only test your wallet, it tests your patience, discipline, and ability to control fear and greed. Small Blue Diamond, why psychology matters in investing. Two people with the same income can have completely different financial outcomes, all because of how they think and behave with money. Your emotions can be your biggest enemy if you let them control your investing decisions. Pushpin example. During the 2020 COVID crash, millions of people panic sold their stocks. But those who held on or even bought more saw their portfolios rebound and grow massively when the market recovered. Small Blue Diamond key psychological traps investors fall into. Fear of missing out, FOMO. When a stock or crypto is skyrocketing, people rush in, usually too late. White heavy checkmark solution. Stick to your strategy. Don't chase hype. Loss aversion. Humans hate losing money more, and they love gaining it. This makes people sell too early or avoid investing altogether. White heavy checkmark solution. Remember, temporary losses are normal. Long-term growth is the goal. Overconfidence. Thinking you're smarter than the market often leads to risky decisions. White heavy checkmark solution. Stay humble, keep learning, and diversify. Short-term thinking. Many investors expect quick results, but wealth takes decades to build. Pushpin example. Warren Buffett made over 90% of his wealth after age 60 because he let compounding do its work. Small Blue Diamond, building the right investor mindset. Patience is power. Investing is like planting a tree. The best results come with time. Discipline over emotion. Set a plan, monthly contributions, stop losses, diversification, and stick to it, no matter what headlines say. Think long-term. Focus on financial freedom, retirement security, or building generational wealth, not this month's gains. Detach from market noise. News headlines are designed to trigger fear or excitement. Don't let them control your decisions. Small Blue Diamond stories that prove mindset wins. The Bitcoin roller coaster. Someone who bought Bitcoin at $1,000 and held through all the crashes, even when it dropped to $3,000, eventually saw it climb above $60,000. Patience and belief in long-term growth beat fear. The Netflix example. In the early 2000s, Netflix was worth less than $1 per share. Many sold early because Blockbuster was dominating, but long-term believers who held are now millionaires. Small Blue Diamond, how you can master money psychology. White heavy checkmark, write down your financial goals. Clear goals anchor your mindset. White heavy checkmark, automate your investments. Removes emotions from the process. White heavy checkmark, accept volatility. Ups and downs are part of the journey. White heavy checkmark, read books like The Psychology of Money by Morgan Housel to understand how behavior beats knowledge. Key final takeaway. Investing success isn't about finding the perfect stock. It's about mastering your mindset. If you can control your emotions, stay patient, and think long-term, you'll have the greatest advantage in building wealth, creating your personalized investing roadmap, step-by-step action plan. Investing without a plan is like setting sail without a compass. You might drift for a while, but you won't reach your destination. That's why creating your own personalized investing roadmap is crucial. It gives you clarity, direction, and confidence on your wealth-building journey. Small Blue Diamond, step 1. Define your financial goals. Ask yourself, do I want to retire early? Am I saving for a house, kids' education, or generational wealth? Do I want passive income now or long-term growth later? Pushpin example. If your goal is to retire at 55 with $1 million, your roadmap will look very different than if your goal is to build passive income for travel in the next 5 years. Small Blue Diamond, step 2. Know your risk tolerance. Conservative prefers safer investments like bonds, index funds, ETFs. Moderate, comfortable with a mix of stocks, ETFs, and maybe real estate. Aggressive, willing to take risks with growth stocks, startups, or crypto. White heavy checkmark pro tip. Risk tolerance often changes with age. A 25-year-old can afford more risk than a 55-year-old nearing retirement. Small Blue Diamond, step 3. Build a diversified portfolio. Don't put all your eggs in one basket. Spread across. Stock/ETFs, long-term growth. Bonds, stability. Real estate/REITs, tangible assets and income. Alternative assets, crypto, commodities, or startups, small percentage. Pushpin example portfolio. 60% stocks, index funds and ETFs. 20% bonds. 10% real estate, REITs. 10% alternatives, crypto or gold. Small blue diamond, step 4. Create a consistent contribution plan. Wealth doesn't come from one big investment. It comes from small, consistent contributions. Automate monthly deposits into your brokerage. Increase contributions as your income grows. Pushpin example. Investing just $500 per month at 8% return grows to over $745,000 in 30 years. Small blue diamond, step 5. Review and adjust regularly. Markets change. Your life goals change too. Do a quarterly or yearly portfolio review. Rebalance when one asset grows too much. Adjust based on milestones, marriage, kids, retirement age. Small blue diamond, step 6. Add protection, emergency fund plus insurance. Always keep 3 to 6 months of expenses in an emergency fund. Have insurance, health, life, property, so that unexpected events don't derail your investments. Small blue diamond, step 7. Stay committed and avoid noise. Your roadmap only works if you stick to it. Ignore short-term market crashes. Avoid jumping in and out based on hype. Focus on the long-term path you created. Open book example story. Sarah's roadmap. Sarah, age 28, set a goal to retire at 55 with $1.2 million. She invests $600 per month into index funds, increases it by 5% yearly. She adds real estate at 35, bonds at 40. By 55, she reaches her goal, even after a few market crashes, because her roadmap kept her disciplined. Key final takeaway. A personalized investing roadmap keeps you disciplined, helps you measure progress, and ensures your money is always working toward your goals. It's not about predicting the market. It's about preparing yourself to stay consistent no matter what happens. How to avoid common investing mistakes that cost you money. Every investor dreams of growing wealth, but many fall into avoidable traps that delay progress or wipe out gains. By learning what not to do, you put yourself ahead of the game. Small blue diamond, mistake 1. Investing without a plan. Jumping into the market without a clear goal or strategy is like playing darts blindfolded. You buy random stocks because they're trending. You pull money out when the market dips. You don't know if you're investing for retirement, income, or short-term gains. White heavy checkmark solution. Always have a roadmap like we built in chapter 20. Define your goals, timeline, and risk tolerance before buying anything. Small blue diamond, mistake 2. Trying to time the market. Many beginners wait for the perfect time to invest. The truth? Even pros can't predict highs and lows consistently. Waiting too long means missing out on compound growth. Selling in panic during dips, locks, and losses. Pushpin example. If you waited for the perfect dip in 2010, you missed a decade of massive stock growth. White heavy checkmark solution. Stick to dollar cost averaging DCA. Invest a fixed amount regularly, no matter the market conditions. Small blue diamond, mistake 3. Putting all eggs in one basket. Some investors put all their money in one stock, crypto coin, or asset class. If it crashes, so does their portfolio. Pushpin story. In 2008, employees at Enron had their retirement savings invested in the company's stock. When the company collapsed, they lost everything. White heavy checkmark solution. Diversify across stocks, bonds, ETFs, and real estate. Spread your risk. Small blue diamond, mistake 4. Ignoring fees and taxes. High trading fees, mutual fund expense ratios, or short-term capital gains taxes can quietly eat into your returns. Pushpin example. A 2% annual fee on a $100,000 investment can cost you over $500,000 in lost growth over 30 years. White heavy checkmark solution. Choose low-cost index funds and ETFs. Hold investments long-term to benefit from lower tax rates. Use tax-advantage accounts. 401k, IRA, Roth IRA in the U.S. Small blue diamond mistake 5. Chasing hot tips and trends. Buying because a friend says it's going to move or because it's trending on social media can backfire. Pushpin story. Many investors bought into meme stocks like GameStop or Dogecoin at the peak, only to see their investments plummet. White heavy checkmark solution. Research before you buy. Ask, does this investment fit my goals and risk tolerance? Small blue diamond mistake 6. Not having an emergency fund. Some invest every dollar they have. When life throws an emergency, they're forced to sell investments at a loss. White heavy checkmark solution. Keep at least 3 to 6 months of expenses in a savings account before investing aggressively. Small blue diamond mistake 7. Emotional decision making. Fear and greed are the enemies of wealth building. Fear makes you sell in downturns. Greed makes you overinvest when the market is booming. White heavy checkmark solution. Stick to your long-term plan, no matter what headlines say. Open book story example. John versus Maria. John panicked and sold all his investments during the 2020 COVID crash. He lost 35% and never recovered. Maria stayed invested, continued her monthly contributions, and by 2021 her portfolio had doubled. Key final takeaway. The difference between successful and struggling investors isn't just what they invest in, it's the mistakes they avoid. By staying disciplined, diversifying, and sticking to your roadmap, you protect yourself from costly errors. Watch out for the next chapter.